What if I told you you could buy your dream car without touching your paycheck? And this is a question I asked for a new client that use our Wealth Accelerator program. Are you paying for your lifestyle, or are your assets paying for your lifestyle for you? And that made him think, what's a smarter move? Buying a car with cash or using the tax code to his business's advantage and be able to have an asset pay for that car for him? Because it's a way to use appreciating assets to fund your lifestyle without going broke. And I'm here in Pittsburgh at my business partner, Chris Fuge's office, Capital Core Lending. If you need help with any lending or private lending, definitely say look him up. And we use this philosophy for individuals who wants to grow their business or just in general have more money in their pocket. And this allows you to do so much with your money. Buy a dream car, fund that business, help grow financially by using this easy strategy. We're going to talk about that and how you can transform your finances. Before we get started, as always, like, subscribe, share to our channel as we continue to grow. In real life, I'm a certified financial planner on these social media airwaves. We're giving out great information that's going to help you grow. You guys ready? Lego! So this strategy, as we use the whiteboard, helps the individual see clearly what can be done to buy the dream car and have those assets pay for it, right? So we're going to show you as I come on over here. So very simple. We're going to just do So we're going to use that depreciating asset to actually fund a appreciating asset. This is how. Well, number one, anyone with a business, you can use your car as a business write-off, as long as it's more than 50% of business use. We can use Section 179 if our vehicle is over 6,000 pounds, or we can do a bonus depreciation. So how do we do this? You buy a car, but you put down as little as possible because we're going to use our assets to actually pay off that car. So in this case, this person's dream car, he was a videographer, he did photography, so he liked muscle cars. He had a Scat Pack for all you youngins out there. I guess it's a Dodge that grows. I'm more of a luxury person myself, but in this case, it was a $70,000 car. Well, with that $70,000, we can depreciate everything if it's tied to our business. And we was able to do that for him, right? So that $70,000, paying very, very little down and pay a small amount a month, then he's able to then get money back on taxes. Because by doing the bonus depreciation, this allows him to get everything back, the full purchase price of that car, end of the year. So then number two, with that money, he met with Chris here at Capital Core Lending Group, and they was able to get it structured where he was able to buy a property. So now we buy the property. Well, that property is now giving him rental income to the tune of $1,200 a month. Now, $70,000 after taxes, what he got back was about $25,000. That $25,000 allowed him to do a down payment on a rental property. That down payment, now he is paying a mortgage. That is correct. But the rent that he is getting, is basically paying the mortgage and paying the Scat Pack or the Dodge Charger payment on a month-to-month basis. So literally, by using the mindset of me investing in my business, first being a 1099 employee, because if you're W-2, you can't use the strategy. If I am a worker that does not have my own business, I don't use this strategy. I can only do it if I am a 1099 employee. But that $70,000 car, doing the bonus depreciation, instead of depreciating over years, we get all that money back in 1 year. That $25,000 that they receive, structure it where they get a loan and buy a rental property. the rental property that they buy is giving them rent. That $1,200, A, pays for the mortgage, and then also B, pays for the car payment. So now we're using a depreciating asset that's going to go down. In 2 years, that car that he bought for $70,000 is not going to be worth $70,000. In 4 years, it's not going to be worth $70,000. So he's using something that's going down in value and using the proceeds from a tax standpoint because he used our SSS wealth structure, strategy, and wealth. Because he did that, now he's able to buy a appreciating asset. And with this appreciating asset, it has two different functions of cash flow growth. Number one, paying him, which is great. Number two, now it's an asset that's appreciating. So as the value of his car is going down, the value of his property is going up. Now, of course, it's not like a stock where we know how much is going to go up each day, but we do know over time real estate goes up. The value of this property 4 years from now is going to be higher than where it is today. So we use a depreciating asset to buy a appreciating asset. So something that's going down in value like a car, and we use that to buy something going up in value, which is a house. And then we use the money that we make that's going up in value to pay off that car. Very, very simple strategy that individuals don't take advantage of. And to take a step further, well, from a tax standpoint, we are able to make even more deductions. Because if we have a short-term rental, now this is a long-term rental, so he didn't want to do short-term. But in the case of doing a short-term rental, in the tax code, if a person does a short-term rental, I am able to do a cost segregation study, which means instead of depreciating the value of that house over 37 to 40 years, I get to say how much that is in 1 year. So I don't get write-offs for 37 years from a depreciation standpoint. I get it all back in 1 year. That's a lump sum. Theoretically speaking, this house being $120,000 purchase price. If it's $120,000, cost segregation study is 20% of that. That is $24,000. So $24,000, boom, write-off standpoint at his tax bracket, it's about $8,000. So not only do I get appreciation, I get rental income, but I'm also able to tie that against my income, which means I get more money back. If he did the short-term rental with all the other deductions that he had, it would have given him another $14,000. Meaning, he could take that $14,000, do it all over again. Buy another property, more income, and another appreciating asset. So this is the strategy that you can do to not ever, well, I can say ever, but not have a car payment. We first buy the car, put a very, very low amount in, use the proceeds from a tax standpoint, write it off, buy appreciating asset, and then have the rent of the renters, A, pay the mortgage and pay off that car note. And then number three, we use the purchase price of that house to get all that money back from a write-off standpoint in 1 year, and we do it all over again. These are the strategies that we employ in our Wealth Accelerator program. The pathway, the financial freedom and growth. So, which is below. Our Wealth Accelerator webinar we have to teach you the strategies, the structure, and speed of growth for your business, and also our website as well that you can see more information. Like, subscribe, share, as our social media is there below as well, at Payneful Profits on YouTube and at Instagram, Payneful Profits as well. But we're here to help. It's so many things that you can do from a tax standpoint, from a structure standpoint, and from an asset standpoint to make the same money that you make now, but bring home more. And we help you do that. So, depreciation to appreciation, $70,000 car turns into a write-off, turns into a $125,000 house, which turns into rental income that pays my loan on the house and pays my car payment as well. And with the short-term rental tax write-off, I do it all over again. Let's make some painful profits together, y'all. Peace.